Guys, and welcome back to another episode of the MD Investor, where we talk about personal finance, increasing our financial IQ so we can break the cycle of generational poverty. If you're new to the channel, welcome. Just a regular guy, not a CPA, not an accountant, nothing like that. But we are serious and passionate about personal finance. So let's get into it. I came across this article, and with everything going on now, with the stock market at an all-time low, with the Fed recently increasing interest rates, mortgage rates going up, war going on in Ukraine, labor shortage, that everything going on, it made me reflect on 2008 when the stock market, the Great Recession, stock market was dropping. You saw your account balance just going down and down, and I sold. Cardinal rule: you do not sell in a down market. I sold, but this time is different because of everything I've learned in the interim years. So I said, you know what? Let me be the calm to help soothe the fears of people who may be a little nervous about everything that's going on. So let's get into it. On YouTube, it's MD Investor. Instagram, MD Investor One. So let's get into it. So this is an article from Yahoo Finance. Said that the S&P 500 is having its worst year so far in 6 decades. Not great news. The S&P 500 is having its worst year so far in 6 decades. And we already know. You check your account balance and you see it's going down and it's lower today than it was the day before. And your numbers are dropping, right? So, you have an account balance of whatever, and now it's 20% lower than it was. And this is cause for concern and can cause people who are a little inexperienced to sell like I did in 2008. Okay, so we're not going to read the whole thing, but let's kind of get some points here. Okay, so it says here, and today is Thursday, May 12th. Thursday, May 12th. It said the S&P 500 rebounded ever so slightly on Tuesday, 2 days ago, but failed to recoup losses from Monday's ugly session and hovers closer to a bear market in the midst of sky-high inflation and a hawkish Federal Reserve looking to end easy money at last. Bear market basically means a drop of 10%. Sky-high inflation, we say inflation normally is 2%, and now we're about 8.5%. And a hawkish Federal Reserve looking to end easy money at last, which is why they raised the interest rate. We did that in our last video. Now look at this sentence here. While there's still 3 weeks left, while there's still 3 weeks of trading left in May, 2022 has been the worst year-to-date return. So it's been, the S&P 500 is down 16.3%. So far, relative to overall down years for the index, save 1962. So while there's still 3 weeks left in the month of May, 2022 has been the worst year-to-date return since in the last 6 decades, except for 1962. The market is down 16%. Based on past data, it is likely that the index will continue to underperform throughout the year, right? Based on past information, it's going to keep going down and down and down. Even if the S&P were able to recover some losses by the end of this month, it's likely year-to-date negative return would still fit the pattern of a down January through May period. That's highly typical of losing S&P years. So normally, in the year where the S&P lost value, the first 5 months is usually bad. So they're saying the first 5 months is bad, has been bad, even though there's a couple of weeks left in May, and that fits the pattern of a down 2022. The S&P entered a free fall last week, augmenting analyst forecasts for a bear market. And we said a bear market is at least 10% drop. The index has a 10% drop at one time. The index has endured 5 consecutive weeks of decline, the most since 2011. So all these things are negative, record, but bad record. By midday Tuesday, the S&P 500 was trading at 4,025, slightly up from Monday's close. If the index drops below 3,854, this would represent a 20% decline from the intraday high, which experts warn could qualify as a bear market. I said a bear market is 10%. It's actually a 20% drop. A 10% drop is called a correction. My mistake. So 10% drop, correction. 20% drop is called a bear market. Other headwinds include the ongoing conflict in Ukraine and the national labor shortage have contributed to a poor year for the stock market thus far. According to DataTrick, S&P 500 losses during the first 5 months of the year bode poorly for the index as a whole during the rest of the year. That's what I said before. If it's going to be a bad year, the first 5 months usually starts off bad, which is an indication of what we are experiencing right now. Based on historical trends, the S&P 500 will continue to underperform during months June through October, when negative returns are recorded during the first 5 months of the year. Okay? So usually when it's bad the first 5 months, it continues until October. In November and December, losses are generally reined in and returns flatten out. I think we get the picture. So the picture is the market is going down. And there's a lot of factors. We mentioned the inflation, the war in Ukraine, supply chain problem, geopolitical tensions. So there's a lot of factors to explain what's going on in the market. Now, let's talk about our action. We said in 2008 when it happened to me, inexperienced, didn't know what was going on, seen my account value drop, I sold. Huge mistake. You never want to sell down. Now, let's look at actions that we should be taking. Now, if you want to invest in the market, what they call the S&P 500, that's one index, you could buy an index fund, where we talk about index fund all the time. You can buy it from any brokerage account. So you can buy it from Fidelity. They have an S&P 500 index. You can go to Google, type in, Fidelity S&P 500 index fund. And there's a fund. A fund is basically a basket of stocks. So here is Vanguard, because I use Vanguard. Vanguard 500 index fund, Admiral shares, which just means you have to buy at least $3,000. Anyhow, this is the cost of the Vanguard S&P 500 index fund. Right now it's trading at $363. You see here the first trading day of the year, which was January 3rd. It was trading for $440.38. Correction, $442.63. That's what it was trading for at the beginning of the year, so about 5 months ago. You see right here, year to date, it's down 17.85%, or just under about $79. It's down, right? So from 442, and today, right now, it's about 363, a drop of 17.85%. If you were to sell, you would lock in your losses of almost 18%. smart thing to do is wait for it to go back down. Or let me add, the smart thing to do is buy more now. Someone said, I think it might have been Warren Buffett, people get excited for a sale in every place except for the stock market. Great companies which are in the S&P 500, so your Amazon, your Google, your Apple, they make up part of the S&P 500. They're on sale because of what's going on, right? So they were priced here, now they're priced down here. I'm going to introduce a concept called DCA, or dollar cost average. Dollar cost average is basically when you invest the same amount of money into the market at a regular interval. Why would you want to do that? We're going to get to that in a minute, but that was a good question. So imagine if you were investing imagine if you're investing $440, $442.63 every month in the market. On January 3rd, that would buy you one share of this VFIAX, Vanguard 500 Index Fund, because you're doing $442 every month. Fast forward now, and you're still investing that $442 every month. Now you can buy the fund for only $363. You see how now your money's going to stretch farther? You'll be able to buy only one share over here January 3rd, but now, in the middle of May, you'll be able to buy one share, and then you'd have like $80 left over. So maybe 1.3 shares or 1.2 shares. That's what DCA, or dollar cost average, is. So whenever you hear people talk about dollar cost average, it means that you put the same amount of money in the market at regular intervals. Sometimes when the market is high, you'll get less shares, right? So when the market is high, like in January 3rd, you'd get less, you'd only get a share. When the market is low, you'll get more, like now. That way you don't have to time it, okay? And it kind of evens out that when the market is high, you get less shares, but when the market is low, you get more shares. And you keep doing the same amount regularly, and eventually you get that best price. So, to get back, what do you do now that the market is low at 363? Your money will go further. You have extra cash, put more money in the market. Put more money in the market. Because I know they're saying that, it's probably going to be a prolonged period of a down market, maybe until end of the year, October or so. But if you keep getting additional shares by investing when the market is at 363 and whatever, 350, if it keeps falling, but you're still getting that one share, your money is going further. When we end up over here in whatever the end of the year or 2023, and the market goes back up, your share count is more than it would have been if the market was high. And then when the market comes back up, you have all those shares, and when the price goes up, that's when you're going to see your account value increase. That's what I didn't do in 2008, the Great Recession. But this time, it's going to be different. So we can look at another index fund. This is Vanguard Total Stock Market Index Fund, VTSAX. This has about 4,000 stocks. So in addition to the S&P 500, which is the 500 biggest company, it has another 3,500 stocks that makes up this index. So about over 4,000. And that's also been affected, right? In January, when the market, beginning of the year, January 3rd, it was $118. Now, $95, down about 20%, 19.5%. Okay, year to date. Same thing. You can DCA, dollar cost averaging. So the take-home message, guys, is hold on. Things are going to get better. This is a buying opportunity, which you would normally not have. Put your money to work in the market, broad index fund, and you're going to be very happy you did when the market recovers. Whether it's 2023 or the end of 2022, you're going to be very happy you did. Again, guys, MD Investor, that's trying to increase your financial IQ so we can break the cycle of generational poverty. Remember to subscribe on YouTube at MD Investor and on Instagram, MD Investor1. And until next time, continue to command your money to grow. If there's somebody out there you think could benefit, send them the link. Don't keep it to yourself. And I will see you on the next one.